of people.
I'm going to start recording and we can admit folks. All right. Hello, everyone. Thank you for joining today's briefing on financial industry greenwashing. My name is Jackie Fielder. I am the communications coordinator for Stop the Money Pipeline. We are a coalition of 175 groups working to hold the financial backers of climate chaos accountable. Today, we are joined by a slew of amazing climate finance experts and advocates, and who all will be speaking about the growing pressure on financial institutions to make real commitments to stop financing fossil fuels, as well as the greenwash commitments that banks, asset managers, and insurance companies have issued to date and are expected to continue to announce around the COP26 climate talks. So we are confident that you will come away understanding how to discern whether a financial institution is truly aligned with the Paris Climate Agreement or not after this. So to begin, I am going to introduce our first speaker. Tom Goldtooth is a Diné and Dakota environmental and Indigenous rights organizer, advisor, and leader in the grassroots movement. He is the executive director of the Indigenous Environmental Network and has been awarded with the recognition of his achievements throughout the past 40 years as a change maker within the environmental, economic, energy, and climate justice movement. So I'm going to hand it over to Tom.
Yeah, thank you, Jackie. Yeah, it's good to be on this panel. In addition to the work that I've done, we work closely with Indigenous peoples, not only here in the north of US and Canada, but also Indigenous peoples of the global south, and specifically related to national and United Nations, our global mitigation and adaptation on climate change. We work a lot with Indigenous peoples in the Amazon and the tropics. Back late last year, fall 2020, IEN signed on with 60 climate and human rights groups on a new set of principles for Paris-aligned financial institutions, climate impact, fossil fuels, and deforestation. These principles offer what we call a roadmap for the decarbonization of the finance sector on a timetable that's aligned with the Paris Agreement. This has been very critical and important for Indigenous peoples as we look for real solutions to this climate issue that we're all facing here in the United States. It's been very critical with our tribes, our tribal nations and communities, and especially our traditional practitioners. Our position is that financial institutions must adopt a commitment by this upcoming Conference of the Parties 26 in Glasgow that requires that all the projects and the companies that they support are aligned with the 1.5 Celsius goal. Financial institutions and their clients cannot achieve the Paris alignment through net zero accounting based on discredited schemes such as carbon and conservation offsets. Nature-based solutions, carbon capture and storage, regenerative agriculture that puts the forests and our soils into carbon market systems, and other untested negative emissions, quote unquote, are geoengineering technologies. Net zero accounting, or what is better known as net zero emission goals, are locking us into more fossil fuel extraction and climate change. Net zero is not about reducing emissions. Rather, they are a continuation of the 20 years of misguided climate policy based on false solutions like carbon offsets and techno fixes, such as what I mentioned, carbon capture. Net zero emissions, I feel, are a distraction based on distortions and lies to the public so that the fossil fuel extraction industry will continue doing business as usual into the next century. Indigenous peoples are targeted around the world for access to their forests and their ecosystems, while our lands and territories are sought for net zero offsetting schemes that do violate not only our free, prior, and informed consent, but the territorial integrity of Mother Earth, the rights of nature of Mother Earth. And it does cause division and chaos and drives the price of land on one side of the river up. On the other side, you know, our indigenous peoples live next to many of these fossil fuel extraction sites and subject to a whole realm of environmental injustice and the rights of our people to practice our culture and spiritual heritage. So we need to keep fossil fuels in the ground. And as we fight pipelines, we have to be aware that carbon capture pipelines are being funded and expanded through the infrastructure packages moving through the Hill right now. These would be seen as an answer to climate change and are nothing but more of a false solution, a greenwash. Mother Earth is the source of life which needs to be protected, not a resource to be exploited, privatized, and commodified as a natural capital. Thank you.
Thank you so much, Tom, for your words and your work. And just a reminder, we will have Q&A after all of our speakers, so please, journalists, put in your questions. And our next speaker hardly needs an introduction. She went viral for using a whiteboard while grilling the CEO of JP Morgan Chase, Jamie Dimon, over how an entry-level employee at his bank couldn't make ends meet. As a member of the House Oversight and Reform Committee and vice chair of the Subcommittee on Government Operations, she's asked tough questions of bank CEOs and administration officials to hold them accountable to the American people. She represents the 45th Congressional District in Orange County, and this is Congresswoman Katie Porter. Thank you for joining us, and the floor is yours.
Thank you so much, and thank you to all of the other panelists for joining today. Before I came to Congress, I was a law professor and consumer protection attorney. I served as monitor to the big banks on behalf of California families during the foreclosure crisis, and that gave me a chance to see firsthand why many people of my age and younger do not have the trust in big banks or in big business that previous generations did. There is a reason for that lack of trust. Those industries have abused the very capitalist economy, including workers and consumers, that have allowed them to profit. Now, when I first launched my campaign for Congress, I said that I wanted to run on a platform of consumer protection. I knew from 2 decades of experience that there is no one across the ideological spectrum, no one, Democrat, Republican, independent, voter, non-voter, Black, brown, white, young, old, nobody likes to be cheated. But I was told by political operatives to choose a more traditional platform like healthcare or national security, but I didn't listen to them. I stood up for consumers and I won my race in a very, very tough district. And now that I'm in Congress, I continue to apply that same lens of consumer protection to a whole host of issues, not just finance. And I found it's a really useful way to understand Washington, where corporate special interests are used to getting their way by cutting checks to representatives. And on top of the many publicized reasons that banks have given us to mistrust them, the subprime mortgage crisis, CEOs getting large bonuses while their employees cannot afford to put food on the table, the exorbitant fees that they charge. Banks have bankrolled the climate crisis that threatens lives and livelihoods, and they continue to do it today. The Banking on Climate Chaos report, which I'm sure we're going to continue to hear more about today, detailed how the 60 largest banks in the world have invested $3.8 trillion in fossil fuel expansion since the Paris Agreement. JP Morgan Chase alone invested $317 billion, again, since the Paris Agreement. So in June, I led a letter with my colleague Elana to JP Morgan CEO Jamie Dimon requesting information about the bank's lending policies for oil and gas clients. These banks know that financing oil and gas projects is risky, and we are concerned that they might use their COVID relief funds to cover losses if their investments didn't pan out. Now, the banks responded with more greenwashing rhetoric, saying that they have publicly recognized that climate change is an existential threat, is a critical issue of our time, and they reiterated their commitment to the Paris Agreement. But that commitment, that promise is empty without action behind it. Banks' profit motives are not going to change without guardrails and public pressure. Jamie Dimon and other bank CEOs are not going to wake up one morning and say to themselves, you know what? I want to make less money this year. I want to completely change our bank's practices. Americans need to be able to put that pressure on to fight for our planet. And to do that, Americans need to know how their investments are being spent and whether the nation's largest companies are contributing to climate change. That transparency, that accountability for the American people is going to take both legislation and oversight. Congress is going to act to pass the Build Back Better budget, and there is agreement across the political spectrum that we should invest in modernizing our nation's infrastructure, but that has to come with addressing climate change through that budget reconciliation bill. We have to support green jobs. We have to build a more sustainable future. We have to build infrastructure, make those investments that are forward-looking, that address climate change, that reduce emissions, that will put our economy on a path to grow for decades to come. That growth is going to go to the nation who makes investments in clean and green manufacturing and transportation and energy production. Last week, I published an op-ed in the LA Times with Public Citizen detailing how Congress has a rare opportunity in this moment to end federal tax subsidies and tax breaks that artificially prop up fossil fuel development. In the Build Back Better budget, the House included common sense oil and gas reforms that would dramatically reduce big oil's exploitations of taxpayers. And these reforms, by the way, like my bill, the Ending Taxpayer Welfare for Oil and Gas Companies Act, has bipartisan support in the Senate from Senator Grassley on the Republican side and Senator Rosen on the Democratic side. That's because this is about protecting taxpayers. The budget also includes unprecedented investments in renewable energy, electric vehicle infrastructure, and our public lands. But these changes will not happen in a vacuum. That is why America's financial institutions need to get on board. We need their loans and their lending practices to match their rhetoric about the urgency of climate change. Now, we can use our oversight authority in Congress to hold businesses accountable, both big oil and big gas, but also the big banks who are funding these projects. The American people are really tired of the hypocrisy of big corporations saying one thing in public and then doing another thing behind closed doors. So when Jamie Dimon says, as chair of the Business Roundtable, that corporations should serve not just shareholders, but stakeholders, including respecting the people in our communities and protecting the environment by embracing sustainable practices, end quote, I'm going to hold him and other CEOs to exactly that. There is a tremendous risk both financial and otherwise, if we don't curb the climate crisis. Fighting climate change today is so much cheaper than allowing things to get worse. More natural disasters, more erosion, more challenges in agricultural production. We need to solve this problem now. We have already waited too long. It is more expensive to wait and fix the damage later. In California, we know firsthand the urgent need to take bold action on climate. There were two major wildfires in the district that I represent last year, and across our state, we are seeing year after year of record-breaking fire seasons that are taking lives, they are devastating livelihoods, and they are exhausting the current firefighting tools and technology that we have. So it is past time to put people and our planet before polluters and profits. There is so much work to do to build a sustainable future for our kids. I'm a mom of 3 school-age children, and I have listened to them talk about how they feel like our home state is on fire. I want to close by thanking every one of our speakers today for their partnership and their advocacy in combating the climate crisis. Together, we're going to get this done.
Thank you so much, Congresswoman Porter, for your work in holding the backers of climate chaos accountable and for their greenwash policies and for putting our economy at risk. Thank you. On that note, I will be turning it over to Alison Kirsch, the climate and energy lead researcher at Rainforest Action Network, who will speak on bank climate policies.
Great, thank you so much, Jackie and Tom and Representative Porter. I am going to, as Jackie said, pick up right where the Congresswoman left off and just get into a little bit of detail about how to spot greenwashing in private banks' climate commitments with a focus on their fossil fuel policies. So as we know, here we go. The goal of the Paris Agreement is to limit global warming to 1.5 degrees above pre-industrial levels, which the IPCC and others have shown means effectively zeroing out emissions by mid-century. In other words, that's where net zero by 2050 comes from. Then a few months ago, the IEA became only the latest institution to show what other models have been showing for years, which is that we have enough fossil fuels in development to blow our carbon budget, and thus to limit climate change to 1.5 and reach that net zero by 2050 goal, there can be no new coal, oil, or gas development. Thus, it's only logical that banks that have committed to net zero emissions by 2050 must end their support for new coal, oil, and gas. So here is a sampling of major banks around the world that have committed in some way to reach net zero emissions from their financing by 2050. And of those banks, here are the ones that have committed to end financial support for new coal, oil, and gas. You're not seeing an error here, it is an empty set. So that's a key takeaway, right? If banks and their net zero commitments cannot be taken seriously on climate if they continue to fund fossil fuel expansion, as they all do. Similarly, deforestation is a significant contributor to global emissions, meaning that banks that talk a big game on climate cannot continue to fund the expansion of industry-driven deforestation. So with that said, let's dig into a few other indicators of greenwashing that are often hidden in bank climate commitments. First off is slippery language, and there are so many instances of this that I could point to. But with regards to net zero commitments, does the bank actually commit to reaching net zero emissions from its own financing? A great example here is JPMorgan Chase, which often does get credit in the press for having committed to net zero emissions. But when you look closely at the language, they have not explicitly done so in contrast to their peer Wall Street institutions. For banks that have made those 2050 commitments, do they have short-term targets, right? We cannot afford for climate change to be an issue that banks essentially hand off to the executives that will be in power in 2049. And for banks that do have interim targets, a big concern for us is where they use or accept emissions intensity as the metric, a proportional metric, which is in particular an issue for the oil and gas industry. This scam is taken straight from Big Oil's playbook. And, we just have such a clear mandate in terms of, the absolute reductions in emissions that are needed, that setting targets based on reducing emissions, for instance, proportional to dollar of financing or barrel of oil that their clients produce, that just doesn't cut it. Banks love to talk about engaging with their high carbon clients and supporting them through the energy transition. And we have to ask ourselves, where has that gotten us thus far if they've been doing that for the last 2 decades? If banks are going to continue to engage with these clients, at the very least, there need to be clear requirements, for instance, that these clients stop producing new fossil fuels, and consequences, for instance, that without a plan to do so in place by the end of the year, the bank would stop providing new financing. Throughout bank policies broadly, we often see a focus on lending. And while, of course, this is an area of significant impact and concern for banks, it is not the whole picture. We need bank policies to contend with all of the ways that their businesses uphold the fossil fuel economy, including their underwriting of share and bonds. Another red flag is if the bank's approach to reaching net zero emissions involves reducing emissions a bit, but then just buying carbon offsets to offset the rest of its financed emissions, as Tom briefly touched on. Carbon offset mechanisms of all sorts have proven deeply problematic, often fail to reduce emissions, and spur human rights and other abuses. And actually, Rainforest Action Network has a position paper out today that gets into a bit more detail on this, and we can drop the link in the chat. Emissions are often grouped into operational emissions and then the indirect emissions associated with a company's operations, associated with a company's investments or the use of its services. Banks at this point are recognizing that they need to be held responsible for their indirect emissions, that is the emissions associated with their financing, but they do still largely or often accept data and targets from their clients that only cover scope 1 and 2 emissions. We need banks to be measuring and cutting the scope 1, 2, and 3 emissions from their clients. And last but not least, I am willing to bet that almost everyone on this call has been in the scenario where you ask a bank for comment about a particular fossil fuel project or company that it's financing or its fossil fuel financing, and you get an answer in which the bank boasts about its clean energy financing commitment instead. Clean energy financing is additive. It does not cancel out fossil fuel financing. And these sort of responses from banks are, at best, dangerous diversions from the urgent topic at hand about reducing fossil fuel financing. So in conclusion, in the past 5 years, we have seen banks, move from evading responsibility to act on climate to recognizing that they need to act, but using a lot of these smoke and mirror techniques to kind of kick the can down the road. So it's really crucial for us all to see through greenwashing tactics like what we talked through here. And I really appreciate your time and attention today. Thank you.
Thank you so much, Alison. And as Alison said, the Rainforest Action Network has a position paper today that is titled "What's Needed Now to Avert Climate Chaos." So that will be in the chat. And press participants, you're welcome to submit questions for Q&A that we will answer after our speakers have presented. And now we will hear from Elana Sulakshana, Senior Energy Finance Campaigner at Rainforest Action Network, who will be speaking about greenwash climate commitments within the insurance industry. Sulakshana, the floor is yours.
Okay, great. Thank you, Jackie, and all of my fellow panelists. As Jackie shared, I will be examining the often overlooked role of the insurance industry in driving climate change and evaluating their fossil fuel commitments. So to kick us off, why insurance? As society's risk managers, insurers are a critical linchpin of the fossil fuel economy in 2 ways. One, if a project is not insurable, it's not bankable. So most fossil fuel expansion cannot be financed, built, or operated without insurance, and existing projects cannot continue to operate. Secondly, with an estimated $24 trillion in assets, insurers' decisions on where to invest influence the direction of the global economy, and they have a lot of money in fossil fuels. One would think that insurers should know better, as they're on the hook to increasingly pay out billions in claims for climate-fueled extreme weather each year. The insurance industry is starting to acknowledge that their activities drive climate chaos, but right now are much more likely to refuse coverage for homeowners in wildfire zones in California rather than oil and gas clients. So since 2017, more than 30 insurance companies have restricted insurance support for coal, led by major reinsurers in Europe. However, many companies in the US, like AIG and Berkshire Hathaway, as well as in East Asia, have so far refused to adopt any restrictions on coal. Those are the laggards on the right. And not all coal policies are created alike. So, for example, Liberty Mutual has limited insurance for coal companies, but is still able to insure some new coal projects. And it has refused to cancel plans to build its own coal mine through its investment arm. As we know, though, coal is just the tip of the iceberg. When it comes to policies limiting insurance for oil and gas expansion, there are far, far fewer. So to repeat the point that Alison just made, because it's a really important one, any financial institution that has committed to achieving net zero emissions by 2050 must immediately end their support for new coal, oil, and gas infrastructure. Every company here on this slide with the yellow box has made a net zero commitment for their insurance portfolio, and yet only one of them has prohibited oil and gas expansion. And all the companies without yellow boxes have not made any long-term commitments to decarbonizing their insurance services. So what are they doing instead? I'm going to run through 5 of the key greenwashing trends to be on the lookout for with insurance companies. Okay, the first is operational emissions. Some US insurance companies have not even acknowledged that they must address the carbon footprint of their insurance and investment business. For example, Travelers, which is one of the top oil and gas insurers globally, made a pledge to become carbon neutral by 2030 earlier this year. But the scope of that pledge only included its operational footprint. We all know that the electricity used to power its office buildings and miles traveled in company cars are a drop in the bucket of Travelers' total carbon footprint. Next, we are seeing insurance companies delay action by pivoting the conversation to the need to measure and disclose their insured emissions. Measurement and disclosure are important, but when insurance companies say that they cannot restrict fossil fuel support or set goals to cut emissions because they first must comprehensively understand their entire carbon footprint, as AIG is arguing currently, that is a form of greenwashing. Insurance companies do not need to wait for complex insured emissions methodology to act on what the IEA has made clear. No fossil fuel expansion whatsoever. Third, we see insurers say they don't want to invest in certain sectors because of the carbon intensity of those sectors, but they'll happily take insurance premiums from them. For example, SCOR restricts investments in tar sands companies, but has refused to limit insurance support for tar sands pipelines and extraction projects. This is a huge gap, as the unique leverage that insurers hold lies in what they do and do not underwrite, more so than their investments. And next, net zero, as we've heard about quite a bit. Earlier this year, 8 insurers came together and formed the Net Zero Insurance Alliance, committing to reach net zero emissions in their insurance and underwriting, as we saw on the previous slide. In July, the Alliance released its initial guidance, which recognizes that insurance underwriting is a critical tool to fight climate change, but stops far short of making any recommendations to restrict fossil fuel support or even set interim targets, again, kicking the can down the road to future CEOs and executives. Finally, like the banks, insurers also love to talk about how they're committed to engaging with their high carbon clients and supporting their transition plans. So they need to keep insuring them. Without clear accountability measures and deadlines for clients and transparency and oversight, the public, regulators, this is just a free pass to ensure polluters keep polluting. In recent years, the veil has been lifted on the insurance industry, can no longer keep hiding behind its silly TV mascots, and yet the industry continues to delay action while professing their support for the Paris Agreement on one hand, paying out for massive climate disasters on the other. It's crucial that we continue to call out that gap between their rhetoric and real climate action. Thank you.
Thank you so much, Sulakshana. And I am now going to point out that we have a summary of all of the points that our panelists are making today that will be available on the Stop the Money Pipeline website. And we'll also be following up via email with all of the relevant links to reports that are pertinent to this discussion. And I believe that link will be available in the chat. So next we'll hear from Paddy McCully, Energy Transition Analyst at Reclaim Finance, who will present about all the net zero alliances we've been seeing over the past several years and whose greenwashing we will continue to see around COP26.
Thanks, Jackie. Thanks to all my fellow panelists and to everybody who's participating. So just a quick word on Reclaim Finance. We're a Paris-based organization dedicated to the decarbonization of finance. So I'm going to highlight a group of initiatives focused on the concept of net zero, which has become very important in the financial sector over the last couple of years, and especially the last, especially since the start of this year. So it's a pretty confusing array of different initiatives. It's all grouped together now under the heading of the Glasgow Financial Alliance for Net Zero, or GFANZ, which was set up in April 2021 as an umbrella to try to supposedly create some sort of coherence among these different alliances and initiatives. And GFANZ is chaired by Mark Carney, former head of the Bank of England, and also the COP26 presidency, so basically UK government for now. And its initial press release had Janet Yellen and John Kerry on it, so it's been quite it's got good contacts in the world of finance. Of this now 6 members, the first one to be set up predated GFANZ by quite a bit was the Net Zero Asset Owners Alliance, which was set up a couple of years ago. And these other alliances and initiatives have all been created since December last year, which when the Net Zero Asset Managers Initiative started. And just one thing to clarify, the reason why a couple of these are initiatives and in white and the others are in green and alliances is the alliances all come under the UN Environment Programme's financial initiative, and the initiatives don't. So the initiatives in a way have even less accountability than the alliances do. I'm going to go into a little bit more detail on just a couple of these alliances, just given the small amount of time, but it illustrates the points that we want to make about some of the key problems we see. And the big burning issue for us is really, are these alliances actually accelerating climate action, getting us to this zero emissions in 2050, which is where we need to be, or are they actually slowing things down? So Net Zero Asset Owners Alliance, founded in September 2019 by a group of mainly big European insurers and pension funds, big names like AXA and Allianz and Swiss Re. There's only one big US asset owner involved, which is CalPERS, the huge California pension fund. It's grown to now include 48 firms and total assets of over $7 trillion. It's the oldest of these initiatives, also the most ambitious so far. It has released a lot of different papers. It has set 2025 targets, whereas the others only committed to 2030 targets so far. It came out with a policy last year saying there should be no financing of new coal. So that would be, that predated the IEA report, but would be consistent with that on coal. And they also lobbied earlier this year, before the IEA came out with this net zero 1.5 degree report. They actually lobbied, encouraged them to sort of hurry up and do it. But when you actually look what has been the outcome of the Alliance's deliberations, you can see there's at least 28 of their members, including CalPERS, still have no policies that actually restrict funding for new coal plants or mines. Despite lobbying for the IEA to come out with their net zero report, they have not said anything since it came out, and in particular have not said anything on the key demand for no investments in new fossil supply. And while you might have expected the major contribution of the Asset Owners Alliance to COP26 to be something focused on this really significant demand for no investments in new fossil supply, instead, they have come out with a paper promoting offsets and negative emissions. And then the Net Zero Banking Alliance is more recent, launched just in April, has a total of 53 banks, which is a quarter of all global banking assets. Again, we have a problem, like many bank policies, where as of now, it covers only lending, does not cover underwriting. It sets 18 months to set 2030 targets. So given that 2030 is only 8 years away now, and the IPCC is telling us that global emissions need to be halved over this next 8 years to stay within 1.5 degrees, this is a very slow and unambitious timeline. So these founder members include 3 of the big US banks, so Citi, Bank of America, and Morgan Stanley. But now we look at what, in particular, Citi and Bank of America are doing. So just this month, the 2 of them were among the lead underwriters for a bond by Russia's biggest coal miner and coal power plant operator, which is planning major increases in both its coal mining and its coal power output. And then earlier in May, Citi underwrote a bond for the operator of one of Australia's largest coal export terminals, which also has plans to expand. So the big question is, if net zero doesn't mean supporting coal expansion, what exactly does net zero do? At what point are all these net zero institutions going to actually stop pouring money into fossil fuel expansion and start pushing for meaningful year-on-year emission reductions from their fossil fuel clients? And given what we see from the record of these institutions, it all feels a little bit like St. Augustine's famous prayer of "Let me be good, but just not yet." And is this not yet going to be 2050? When are we actually going to see some action? So thank you very much, and I'll hand it back to Jackie.
Thank you so much, Paddy. At this point, I'm going to open it up for Q&A. So participants, please submit your questions and we will take them. And of course, we can take them here. Our panelists are also available offline. And at this point, I also want to direct your attention to an important document that Rainforest Action Network came up with last year in 2020. It is endorsed by around 60 organizations, and it's called the Principles for Paris-Aligned Financial Institutions. So if you're wondering, okay, what would commitments actually look like? Rainforest Action Network and partners came up with answers to those questions. It includes global carbon dioxide emissions must be more than halved, which is in line with Paris, and that financial institutions must prohibit financing for any project and any company that is expanding fossil fuel extraction. So that will be a link available in the chat. But at this point, not seeing any questions in the Q&A. If you would like to follow up offline, you can reach out to me, JACKIE at stopthemoneypipeline.com. Oh, sorry, there is a Q in the chat. I've just returned from Uganda. Net per capita annual carbon emissions, 0.13 tons. They want to develop a big oil field. I was also in Ivory Coast, which has also made a recent big oil discovery. Is the position of panelists in the UK and US that Uganda and Ivory Coast should leave their oil in the ground? This is a genuine question, not a provocation. Wondering if any of our panelists want to take that. Paddy.
Yeah, I'm happy to take that. Yeah, that is a very excellent question, and it does highlight a really key issue in terms of global equity around the fossil fuel, the managed decline of fossil fuels. There is some interesting work being done in this. People like Greg Muddett and from International Institute of Sustainable Development in the UK, and Sivan Kartha from Stockholm Environment Institute. They did a paper a few years ago, maybe just last year, on sort of this issue: how do we account for global equity in the managed decline of fossil fuels? And they're doing further work on that now. I think really what this issue highlights is the need for, in the North, we got to move faster, assuming that the phase out, global equity will demand slower phase out in the global South. And if we presume the 2050 is basically the end date, it does mean that we got to move even more quickly here, which, given the way things are going in the US and in Canada and UK and Norway, other producers, it's not a very encouraging prospect, but I think that's where we want to go. But I think the key thing really in terms of the global South is the issue of expansion. Are we going to, should financial institutions be financing expansion in the global South under the belief that global oil demand is going to increase and prices are going to be high, when we have the IEA saying that there is actually no room for any new projects and that oil prices are going to be low if we're going to get anywhere close to 1.5 degrees because of low demand? And so are we locking these countries into projects that are just not going to perform the way that their backers are saying?
Thank you, Paddy. Any other questions before we hop off? There's one question. We've seen banks come out with coal policies, even though they're riddled with loopholes. When do you think we'll see corporate financing policies for oil and gas majors, if ever?
I can take that one. I wish I had a clear crystal ball to be able to answer that question, and I wish that the crystal ball would tell me, today. But I think not having that crystal ball, what we know is that this sort of pressure to act ahead of the COP is quite useful. We saw in the lead up to the Paris Climate Conference, that's when that first wave of coal policies from banks happened. It essentially became a entry ticket for corporations or for banks to put in place coal policies ahead of the climate conference. So I hope that we see similar movement. But we all are still somewhat far away from banks truly recognizing the drastic action that needs to be taken in terms of their corporate financing of oil and gas majors. And I think, the more that the royal we can do to associate, or to lay clear how far these oil and gas majors truly are from, real action on climate, the better. And there's been great work done by, for instance, Oil Change International that goes through the oil and gas majors' commitments and what would actually be required for alignment with Paris. And you just see like an absolute disconnect there.
Thanks so much, Alison. All right. Well, thank you so much for joining us. We will follow up with all of the participants, with links to reports that we've mentioned, as well as the position paper out by Rainforest Action Network and the summary for this briefing. Thank you all for joining this Greenwash briefing on climate policies that we'll see around COP26. Thank you all.